Two Canadian dividend ETFs. Same category, Canadian high dividend stocks. Same general exposure, financials, energy, utilities. One has a management expense ratio of 0.11%. The other has an MER of 0.55%. On $500,000 invested for 25 years at 8% gross annual return, the fee difference alone produces a gap of $324,192. One ETF costs $550 per year on $100,000. The other costs $110 per year. The expensive one appears in almost every Canadian dividend ETF article. The cheap one is almost never mentioned. The cheap one is XDIV, the iShares Core MSCI Canadian Quality Dividend Index ETF MER 0.11%. Quality screen included. Sector exposure similar. Almost never recommended. Almost never discussed. This is not the only ETF in this category. There is a U.S.-listed dividend ETF that Canadian financial advisors cannot legally recommend to clients because it is not registered for sale in Canada under National Instrument 81-102. That has delivered better risk-adjusted total returns than most of the Canadian dividend ETFs that advisors do recommend. There is a Canadian bank ETF with 1.25% leverage that almost no retail investor knows exists. There is a low-volatility ETF that the academic research says should outperform on a risk-adjusted basis, and that almost nobody in Canadian ETF content ever mentions. This video is 5 of them. The ETFs nobody recommends, but should. XDIV, the Canadian Quality Dividend Index ETF, tracks the MSCI Canada High Dividend Yield 10% Security Capped Index. The index does not simply rank Canadian stocks by yield and by the top ones. It applies a quality screen, selecting for companies with above-average dividend yields alongside solid balance sheets, less volatile earnings, and indicators of dividend sustainability. The result? Approximately 20 holdings, more concentrated than VDY's approximately 40, but specifically screened for the kind of dividend quality that reduces the risk of holding a stock that subsequently cuts its dividend. As of August 2026, XDIV's sector composition is financials 49.47%, energy 26.73%, utilities 9.94%, consumer cyclical 9.37%. If you own VDY, you own very similar companies in very similar proportions for twice the cost. The fee comparison, verified, on $100,000 invested at 8% gross annual return for 25 years. XDIV at 0.11%, MER $667,621. VDY at 0.22%, MER $650,810. XDIV, VDY at 0.2%, MER $650,810. XDIV Advantage $16,810. ZDV at 0.40%, MER $624,176. XDIV Advantage $43,445. XDV at 0.55%, MER $602,782. XDIV Advantage $64,839. On $500,000, the XDIV versus XDV gap reaches $324,192 over 25 years. The fee does not feel like $324,192. It feels like $440 per year on $100,000. The difference between $110 and $550 annually. Small, forgettable, invisible on any monthly statement, but compounded over 25 years on a meaningful portfolio, it is a new car every year in retirement. Why nobody recommends XDIV. It is not a flagship product. VDY has Vanguard's brand recognition behind it. XDV and XEI have iShares brand recognition, but from the higher-profile product line. XDIV is from iShares' Core range, the budget range, and the Core branding does not generate the same search traffic as the primary product names. The content ecosystem has never built up around it because the content ecosystem follows search volume. And nobody searches for XDIV because nobody writes about it. The honest comparison, XDIV and VDY have performed very similarly over 5 years. XDIV 17.94% annually versus VDY 18.46% annually per Portfolios Lab. Similar underlying exposure. Similar return. Half the MER. For investors already holding VDY, comparing it to XDIV is the 30-minute exercise worth doing. Here is the vault, the U.S.-listed Dividend ETF that Canadian financial advisors cannot legally recommend, and the exact Canadian account where it belongs. SCHD, the Schwab U.S. Dividend Equity ETF, tracks the Dow Jones U.S. Dividend 100 Index. The screening methodology is the most rigorous of any major dividend ETF. To qualify for inclusion, a stock must have paid dividends for at least 10 consecutive years. It is then scored and ranked on 4 metrics: cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Only the top 100 qualifiers are included. This is not a high-yield screen. It is a quality screen with yield as one of 4 factors. Companies that pay a high yield but carry excessive debt, earn poor returns on equity, or have been growing their dividend slowly are excluded in favor of financially stronger companies with more sustainable and growing dividends. MER, 0.06%. One of the cheapest dividend ETFs on the planet. Why advisors cannot recommend it? SCHD is a U.S.-listed ETF registered under the Securities Act of 1933. It is not registered for distribution in Canada under National Instrument 81-102. The Canadian Securities Regulation governing mutual funds and ETFs offered to Canadian retail investors. A licensed Canadian financial advisor recommending SCHD to a Canadian client, without the ETF being registered for Canadian distribution, could face regulatory consequences. This does not make SCHD unavailable to Canadian investors. Canadian investors can purchase SCHD directly through a USD brokerage account at Questrade, Interactive Brokers, or other brokerages that offer USD equity trading. The regulatory restriction applies to advisors recommending it, not to investors buying it independently. The exact account, RRSP. Under the Canada-U.S. Tax Treaty Article 21, U.S. dividends paid into a Canadian RRSP or RRIF are exempt from the 15% U.S. withholding tax, zero withholding. The full SCHD distribution arrives in the RRSP, SCHD in a TFSA, 15% withholding permanently lost, no CRA recovery. The worst possible account? SCHD in an RRSP, 0% withholding under treaty. The ideal account, the Canadian alternatives, VIG and VGG for investors who want SCHD equivalent quality dividend growth exposure without the USD account requirement. VIG, Vanguard Dividend Appreciation ETF, applies a similar philosophy. 10+ consecutive years of dividend increases, quality screens. VIG's Canadian equivalent, VGG, unhedged, is TSX listed and RRSP eligible with 0% withholding under the treaty. HCAL, the Hamilton Enhanced Canadian Bank ETF, tracks 1.25 times the performance of the Solactive Equal Weight Canada Banks Index. It holds equal positions in all 6 of Canada's Big 6 banks. and adds 25% cash leverage by borrowing to hold an additional 25% of the bank exposure. The lever is modest by institutional standards. The structure uses cash borrowing, not derivatives, which makes it simpler and more transparent than many leveraged products. The result? When Canadian banks go up 10%, HCAL goes up approximately 12.5%. When Canadian banks go down 10%, HCAL goes down approximately 12.5%. The performance record. Since the fund's inception, the average annual return has been 30.22%, including a one-year total return of 88.63%, reflecting the strong Canadian bank rally of 2025 to 2026. HCAL launched in October 2020, so it has benefited from a relatively strong bank cycle. The honest risk? The leverage amplifies losses, not just gains. In March 2020, had HCAL existed during the COVID bank sell-off, it would have fallen approximately 25% more than the underlying banks. Investors who cannot psychologically hold through amplified declines should not hold HCAL. The 25% leverage is modest, but it is real leverage, and real leverage creates real additional drawdown risk. Why it exists? Some investors are structurally bullish on Canadian banks. They believe in the franchise, the regulatory protection, the dividend growth, and want more exposure than a standard bank ETF provides. Rather than owning individual bank stocks in high concentration, HCAL provides the same conviction exposure through an equal-weighted, leveraged structure with monthly distributions. The equal weight distinction, ZEB BMO equal weight banks ETF 0.28% MER, holds the big six banks with equal weighting but no leverage. HCAL holds them with equal weighting and 1.25 times leverage. For investors who want the equal weight approach specifically and can handle the amplified volatility, HCAL provides what ZEB provides, leveraged. ZLB, the BMO low-volatility Canadian equity ETF, holds the 40 lowest volatility stocks from the S&P/TSX Composite Index, equally weighted. Low volatility is measured by the historical variability of the stock's daily price movements. Stocks that move less get in. Stocks that move more stay out. The low volatility anomaly. Modern portfolio theory predicts that higher risk should be rewarded with higher return. The low volatility anomaly, one of the most surprising findings in academic finance, suggests this relationship breaks down for individual stocks. Specifically, the lowest volatility stocks have historically produced better risk-adjusted returns than the highest volatility stocks, sometimes better absolute returns as well. Baker, Bradley, and Wergler documented this in 2011. The reason? Investors systematically overpay for exciting, volatile stocks. The lottery ticket effect. Boring, stable companies are chronically underpriced. ZLB systematically buys the boring, underpriced stocks. The practical result: ZLB typically experiences significantly smaller drawdowns in bear markets than the broad TSX. In the 2022 market decline, low volatility strategies significantly outperformed. In strong bull markets, particularly technology-driven bulls, ZLB tends to lag the index. The trade-off: smoother ride, similar or better long-term return, lower psychological stress. Who it suits? Investors within 10 years of retirement who cannot afford a large drawdown in their accumulation phase. Investors who are psychologically vulnerable to panic selling during corrections. Investors who want TSX equity exposure with a defensive tilt. Why nobody recommends it? Low volatility sounds like settling, accepting less return to avoid volatility. The academic record says this intuition is backwards, but the marketing of ETFs rewards excitement, and ZLB offers none. CDZ, the iShares S&P/TSX Canadian Dividend Aristocrats Index ETF, holds Canadian companies that have increased their dividends for at least 5 consecutive years. In the U.S. context, Dividend Aristocrats requires 25 consecutive years. In Canada, the S&P standard is 5, a lower bar, but still a meaningful quality filter. Why the consecutive increase screen matters. A company that raised its dividend in 2021, 2022, 2023, 2024, and 2025 has demonstrated 5 specific things. It generated sufficient earnings to cover an increased payout in each of those years. Its management was committed to shareholder returns. It maintained financial discipline through whatever economic conditions those years presented. It was not forced to cut the dividend to preserve cash, and its board was confident enough in future earnings to commit to a higher payment. That is a different filter than pays a high current yield. A company can have a 7% yield for 1 year and cut it the next. A company with 5 consecutive increases has a demonstrated track record. Short, but demonstrated. The MER challenge, at 0.66%, CDZ is expensive relative to XDIV, 0.11%, and VDY, 0.22%. For long-term investors, the fee drag is real and significant. CDZ makes sense if the investor specifically values the consecutive increase screen and is willing to pay for it. For investors who prioritize cost, XDIV's quality screen at 0.11% may achieve a similar outcome more efficiently. 5 ETFs nobody recommends. XDIV, the cheapest Canadian dividend ETF with a quality screen built in that almost no Canadian content creator has ever discussed in depth. At 0.11% MER versus XDV's 0.55%. The fee difference on $500,000 over 25 years is $324,192. SCHD, the U.S. Dividend ETF advisors, cannot legally recommend, with the most rigorous quality screen of any major dividend fund, sitting at 0.06% MER, belonging in your RRSP, where the Canada-U.S. treaty eliminates the withholding tax entirely. HCAL, 1.25 times equal weight Canadian banks through modest cash leverage for investors with the conviction and temperament to hold through amplified drawdowns. ZLB, the low-volatility ETF that exploits one of the most durable anomalies in financial research. Boring stocks outperforming exciting ones, with smaller bear market drawdowns as the practical benefit. CDZ, the Canadian Dividend Aristocrats, consecutive increase screen that selects for demonstrated dividend growth discipline rather than current yield. None of these are in every portfolio. All of them deserve to be in the conversation. The fact that they are not is a function of how financial content works, not a function of their merit. Check what you own. Compare the fee. Ask why you are paying more for the same thing.